Hi guys, Irene here. I hope everyone is doing well. Let's talk about index funds today. We all know index funds or index ETFs are great assets for passive investing, but there are about 200 ETFs listed on the ASX. In this video, I'm going to cover the best ETFs that give you exposure to global stock market as well as Australian stock market to make your portfolio even further diversified on your diversified ETFs. So let's get started. Nowadays, almost every investor will have one or two ETFs in their portfolio. I personally will buy and hold a couple of ETFs while I do my own research on the individual stocks on my watch list. This way, I'm not missing out getting into the market in time, while it gives me more time to do my due diligence on the companies that I'm going to invest, which do take a lot of time. By the way, the ETFs I'm referring to in this video are all equity or stock ETFs, and I'll mention if there's any equivalent managed index fund if you're not a fan of ETFs. Firstly, let's look at the pie chart of the global stock market share by country. Obviously, for Aussie investors, it's not good enough to only invest in the local companies, which accounts about 2% of the entire global market. US market is still the biggest chunk, and we definitely don't want to miss out that slice of cake. To dip in the global markets, probably the best way is to invest in the local ETFs whose underlying assets are international stocks. So today, the ETFs that I'm going to talk about are only ASX listed, and there might be one or two options in each category because some of you may already have holdings of ETFs which could possibly overlap with the companies included in the ETFs that I'm going to suggest. But the idea is to give you a bigger picture when it comes to pick the right ETF for yourself so you don't get lost in the ETF ocean. In this video, I'm only focusing on one asset class, the stock, as the underlying asset of ETFs. So no cash, no bond, no property, no commodity, only stock. And I'm diversifying them among countries because countries are different with their economic fundamentals, economy, policy, industry focus, and political environment. And moreover, the currency returns are uncorrelated with the stock returns. And these may reduce the risk of investing in a foreign country, even that country is a very risky emerging market, just from an equity investment point of view. In Australia, there are 6 major fund management companies. Based on their market share, there are Vanguard, BlackRock, BetterShares, SPDR, VanEck Vectors, and ETF Securities. The fund management by the above companies are the most favorable index fund or index ETFs by the investors. And you may find almost all the products that I'm going to suggest are from those companies. The first is US stock market. There are 3 most widely followed equity indices in the US. They are S&P 500, Dow Jones Industrial Average, Nasdaq Composite. S&P 500 is the most commonly used equity index to represent US stock market. It tracks the performance of the largest 500 companies listed in the US stock exchange based on their market cap. Dow Jones only consists of 30 US blue chip companies. There's no ETFs listed on ASX that tracks the Dow, but you can access to the ETF DIA, or people call it diamonds, if you have an international trading account. The third US famous index is Nasdaq 100, which is a basket of 100 largest, most actively traded US companies except for the financial industry listed on the Nasdaq Stock Exchange. The stocks included in Nasdaq 100 are typically tax savvy. In my opinion, any ETFs that tracks Nasdaq 100 is more of a sector focused ETFs. It's more appropriate to invest in ETFs that tracks a broader equity index like S&P 500. And IVV and SPY can be considered for the ETFs that tracks the S&P 500. Let's review their data by management cost, a 3-year historical return, and the daily transaction volume. SPY is the most actively traded ETFs in the US, but not so much here in Australia, and it was only listed on ASX since 2014. As of 3rd of December, from its average daily trading volume is less liquid than IVV, which could lead to higher bid and sell spread costs. IVV's management fee is half of SPY's management fee, and in terms of return, IVV outperforms SPY's 3-year historical return. There are two other ETFs that tracks a broader US stock market. They are VTS and QUS. One share of VTS gives you holding about 3,500 companies. Personally, I will opt out these two ETFs because simply they're holding too many US companies. Normally, the top companies are heavily weighted in the index. For example, the top 10 companies in S&P 500 accounts about 26% of the market cap of the index. So if you're interested in the small cap companies, either choose a small cap market focused ETFs, or you can invest in the individual companies that you believe have potential growth. Let's move on to global stock market. If you have holdings of US ETFs, you may want to exclude US market after all when you pick the global stock ETF, as you don't want the double dipping. It's very dangerous to invest in the same underlying assets when it comes to spreading your investing risk, because it may seem that you're putting your money into different baskets, but actually all the baskets are the same. So if one basket breaks, the other one is not gonna survive. I have two options. One are the ETFs that excluding US market, and one is including the US market. The ones that excluding US market, I've got IVE and VEU. So let's review their data. Obviously, they're tracking different indices. So VEU's management fee is a lot lower than IVE, and VEU is more liquid than IVE based on the average trading volume as of 3rd of December. And VEU performed better based on its historical 3-year return record, and VEU including 4 times of the holdings of IVE. If you don't have an ETF that includes the US broad stock market, and I've got two options for you. One is IOO, the other is VGS. IOO had better return than VGS based on its historical 3-year return record, and VGS management fee is a lot lower than IOO. VGS provides a higher liquidity than IOO, meaning less bid and sell spread cost than when trading. In terms of the region exposure and weight, IOO and VGS seem to have different emphasis. I have to mention VGS has a equivalent managed index fund. We can see that the global ETFs have concentrated in the developed markets, but if you're bullish about the emerging markets like China, South Korea, India, you may want to have ETFs that focus on the emerging market. But emerging markets normally have less strict reporting standards, transparency, and rule of laws, and the government will have more say on the regulations of the stock market. And all of these factors will make the investing more expensive and less certain. I've got 3 ETFs that you can consider if you are thinking of stepping in the emerging markets. They are VGE, IAA, and VAE. In terms of holding and region exposure, IAA and VAE are both Asia-only ETFs, with VAE exposing to more Asian markets, with only VGE provides emerging market like Brazil. And VAE is the most liquid ETFs among all. VAE provides the lowest management fee of all, and IAA had the highest 3-year historical return record. For VGE, there's a managed index fund from Vanguard called Vanguard Emerging Market Share Index Fund, but it tracks a different index, which is MSCI Emerging Market Index, while VGE tracks the FTSE Emerging Markets. Now, let's move back to Australia stock market. There are about 2,000 stocks listed on ASX, but most of the value is made up by the top 200 stocks by market cap. I got 3 competing ETFs for you to consider. First is IOZ, second is STW, and VAS. VAS has a equivalent managed index fund from Vanguard. It tracks exactly the same index. Let's pull out the data to see who is better. VAS is the only one that holds 300 stocks in the fund, while the other 2 hold 200 stocks. And in terms of the management fee, IOZ has the lowest, and because it has the highest liquidity, which will make its bid and sell spread cost lower. In terms of return, VAS has the highest historical 3-year return. Again, to choose a new ETF, please check and compare the underlying assets in your held ETF to avoid double dipping. For example, IVE from the Global Stock ETF have Australia stocks proportionally included in their portfolios. I purposely give you a couple of options in each category for you to mix and match based on your existing holding of ETFs. And all the ETFs can be traded on ASX market through a broker. Well, that's it for today and happy investing. I'll see you next week. Bye.